Mortgage rates continue to remain stuck around 7%, but in last week's jobs report, it looks like the labor market is finally starting to soften, which is what the Fed is looking for before they'll lower rates. Active inventory and new listings both saw a decline last week, and if you are hoping to buy new construction in the Dallas-Fort Worth market and be moved in before next year, you have to be looking right now. I'll tell you why in a minute. We're covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest both cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to move in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is April 8th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here to get to the latest weekly market update. First up is market news. Last week's jobs report beat estimates, but if you look a little closer, you can see that the labor market is starting to soften. And that's what the Federal Reserve wants to see. Remember, it's my opinion that the Fed cares less about the inflation numbers and more about the labor market numbers, even though all they talk about is inflation. In their mind, there are still too many people employed making too much money, which will lead to higher inflation if they drop rates. And if you're wanting proof, just look at this chart. The green line is the inflation rate, and the blue line is the 10-year, which most closely follows the federal funds rate. So what we can see is these numbers usually follow a lot closer together, in that when inflation is rising, then the Fed is raising rates, so the 10-year is rising. But look what's happened here. Inflation has gone straight down, yet the 10-year has continued rising. This is why it's obvious to me the Fed is not actually caring about inflation. It's caring about something else right now, which is the jobs market. Because look at this. Inflation has come significantly down and is continuing to decline. It's trending down. Okay, so what did we see in this jobs report? Three main things. Number one is unemployment claims are starting to rise, though not that significantly. I mean, look how much lower we are here than where we were even in 2023. In reality, for the labor market to be breaking and for this to really mean something, we would have to be well over 300,000 on the initial unemployment claims, and we're way down here just above 220,000. But what we're always looking for is trends. You can see absolutely we were in a downtrend, and you can see it does look like it's shifted ever since about January. We are slowly climbing up, so all I'm pointing out here is the trend is continuing up. We had a big jump in initial claims, but the point is the trend was down. Now the trend is up. It's continuing up. We had a significant jump. Maybe we get another significant jump the next report. But this is the first sign of the labor market starting to soften. Evidence number two is wage growth is cooling off. And looking at this chart, you can see wage growth was hovering in the mid threes. Then during COVID, it spiked up to 8%. And then all the way through 2022 was between about 5.8 down to 5%. And then in 2023, it went from a high of 4.8 down to 4.3. And it just has been trending down ever since. And now, as of 2024, we have our lowest reading here since COVID, and we are back to a 4.1. So wage growth is not spiraling out of control. It's definitely trending downward. This is something that was very important to the Fed. They were worried about wage growth spiraling out of control. It's clearly not. It's been trending down, and we have our lowest reading to date since COVID. And at 4.1, we are almost back in the threes. So if you'll remember, back here, we had a lot of readings in the mid threes, and we are almost back into the threes. And then our number three evidence is the job openings quits rate is back below pre-COVID levels. This is an important number because it ties in with wage growth. The quits rate is basically if the labor market is hot, there are a lot of people quitting their job to move to the next company that's offering them a higher salary. So when the quits rate is high, wage growth is usually going out of control. Again, the Fed does not want too many people making too much money, because then they spend too much money and then inflation goes up. So as you can see in this chart, the quits rate back here was 2.3 up to 2.4, and we are now all the way back down to 2.2. So those are the three key signs. The labor market is softening. Hopefully the Fed sees that and pivots soon. I don't think they will, though, until we do start to see more of those unemployment claims rise, but everything else is falling into place. Okay, moving on to the national data, let's start with single-family housing inventory. So this week we actually had a decrease of 4,425 homes. As you can see, it's not a huge dip here, but it is the first time in a couple of weeks since we've had a decline. We've been climbing steadily, not super fast, but we have been climbing. So this is our first decrease. This gets us down to 512,930 homes for sale in the country. And so far this year, the good news is it's looking more and more likely. We actually had our yearly inventory bottom way back here on February 16th, which would make this year's inventory bottom the closest we've been to a normal seasonal bottom since COVID happened. Again, I'm not saying for sure this is the bottom, because if rates were to drop, then we could see inventory drop below that. But so far, that's our bottom, and that is good news, because in a normal market, the seasonal bottom is the end of January or beginning of February. In COVID, it was March all the way to April. Last year, it was mid-April before we saw the inventory bottom, so it looks like we may have seen it back in mid-February, which is great. Okay, now we're taking a look at new listings, and this is the not good news, but again, we're always looking for trends, so we don't panic over a one-week move, but there were actually 239 less homes listed than the corresponding week last year. And this is very bad news, because as you can see in 2022, we've been pretty closely following this year to 2022's new listings data. And we've been quite a bit higher than 2023. So this week we actually fell below not only 2022, but also 2023. Again, we don't panic over 1 week. This definitely could be an anomaly. We're gonna have to wait and see. But realistically, if we want to get back to a healthy real estate market, we need to be not only at these 2022 numbers, we need to be quite a bit higher, because we still have an inventory shortage. And to get out of that shortage, we need two things to happen. One, we need higher days on market to give inventory time to stack up. And fortunately, we are getting that with these high rates at 7%. So half of the equation is there. The other half is we need more people to be listing their homes. So we're halfway headed in the right direction. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year, it's normal for a third of homes to have a price cut before it sells. And looking at this chart, this week we are at 32% of homes had a price decrease nationally. Last year we got as high as 39.2. The year before we got as high as 43.2. But it's normal for this number to start increasing this time of year, and it's a good thing because it means days on market will be going up. And like I said, we need that for inventory to stack up. So all we're looking for on this chart for the rest of the year are aggressive swings in either direction, and those are going to be 100% tied to mortgage rates. But as of now, everything looks normal. Don't be surprised this number is going to be climbing all the way up until probably November. Okay, moving on, let's look at mortgage rates. Last week we were at a 7.05, got as high as 7.07, had a big drop on Thursday to a 6.99, then climbed back up Friday to a 7.01, and I would say we're going to be above this today. If we look at the 10-year, we have some good and bad news. The bad news is obviously we are outside of my yearly prediction range. We were hoping not to break above this black line, and now we are in the danger zone and hanging on for dear life. We desperately need this to drop back in, and as you can see today, Monday, we are climbing back up out of it, where we actually closed inside of it on Friday. Now, the good news is the spreads have gotten way better. Ever since COVID, basically, whatever the 10-year yield has been at, mortgage rates have been about 3% above that, which historically is very high. But the last few weeks, that number has been getting smaller and smaller. That spread has been getting smaller. And recently, we've been as close as about 2.6%, so about a 0.4% improvement, which means we don't need the 10-year yield to fall as far as we used to get a big improvement in mortgage rate. So for example, if we were back to this year's lows down here, this was actually a 6.6% the last time we got there. So if we were to fall back just to this number, today we would be at about a 6.4%. So that may not sound like a huge difference, but you got to remember we're actually trending down. So if this trend were to continue and keep improving so that mortgage rates were only 2.2% above the 10-year yield, then the next time we get down here to about 3.8, mortgage rates would only be 6% instead of 6.6%. So we wouldn't even need the 10-year or the federal funds rate to drop lower than it already has this year, and we could be at 6% rates just from the spreads getting better. I know that's a complicated topic. I don't know if I described it well, but leave a comment if you have a question. The point is we have a good trend. Now regarding mortgage purchase applications, as you can see, the 10-year was pretty steady last week, so we can expect not a big change in the number of people applying for a mortgage. And this actually makes the second week in a row and the second one for the year that we had a completely neutral print. So no plus or minus on the number of people applying for mortgages. However, last week we were down 15% year over year, and this week we're only down 13% year over year. So we still have less people applying this year than they were last year, but the number is trending up. So demand is increasing for this year. Okay, before we move on to the local market data, if you're considering buying a home in the DFW market this year, there are 3 things. Number 1, I'm now doing a weekly online home buying webinar. If you're looking to buy in the next year, this is for you. You can sign up in the link below, or you can also watch an instant replay there. Number 2, I've developed a max affordability calculator that will very quickly and easily help you get into the ballpark of how much home you should actually be looking for based on your personal financial situation. It'll give you several different options to review, and it takes into account everything all the way down to your tax bracket. This is completely free to you, so take advantage of it. If you want to learn more about that, you can watch this video next. And number 3, specifically if you want to buy new construction this summer and be moved in before the next school year, you have to be getting under contract now. If you contract now, you are going to have plenty of options and plenty of floor plans to choose from that are currently being built but won't be completed until June, July, August. If you wait until summer actually starts, many of those homes that are being built now that could be contracted will already be contracted, and you're going to have very few options to choose from, meaning it's very likely you will not get to buy the floor plan you want. I promise you this happens every single year. If you wait until actual summer to start looking, you're basically going to have to walk into these communities and say, I will take whatever you have left. So please listen to me. You can contract today and still not have to close until June, July, August, and you will get to pick the house that you actually want. And this is the only way to guarantee you're going to get the floor plan you want, is contracting now. Okay, now let's take a look at what's happening in our local markets. Starting with the MLS data, looking at Dallas County, we had 612 new listings in the last 7 days. That's 113 more than last week, and that's great news. 307 closings in the last week, 43 less than last week. Of the homes that closed, 94 were immediate sales, meaning they contracted within the first week. That's 8 more than the previous week. 362 homes went under contract. That's 12 more than last week. In total, there are 2,548 homes either under contract or in pending status. That's 43 more than last week. Now looking at Collin County, we had 460 new listings. That's 170 more than last week. 224 closings. That's 103 less than last week. Of the homes that closed, 70 were immediate sales. That's 26 less than last week. 251 went under contract. That's 39 more than last week. In total, there were 1,932 homes either under contract or in pending status. That's 63 more than last week. Okay, let's move on to the Market Action Index, starting with Dallas County. And the Market Action Index is just this easy to read graphic with a number that takes into account all of this data. Anything a 30 or below is a buyer's market. Anything above that, we're asking how much of a seller's market are we in. Dallas County is still a strong seller's market. And just looking at the individual data, you can see the median list price continues to trend up. The median price of new listings, however, has really just been in this range up and down every week. Median days on market holding steady at 42. Number of homes having price decreases as well, holding steady. Inventory had a small tick down this week. But overall, all you're seeing is everything looks normal. Prices are starting to heat up. We're not seeing anything extreme in either direction. We're just seeing the market is starting to get hotter since now we're already in April. Now moving on to Collin County, looking at the same thing. The thing about Collin County is the data is always going to be a little bit weird because a lot of the supply here is new construction. So looking here on paper, it looks like Collin County is a little less hot than it was last month. You can see that curving down here. You went from a 45.7 at the top down to a 43.3. I do not put a lot of stock in this number because the number I'm really watching in Collin County is the number of homes having a price increase every week. I did the actual numbers on this a while back. I think when 8% of homes had a price increase, when I zoomed in to new construction, what that actually came out to was something like 1/3, a little more than 1/3 of new construction homes were having a price increase that week, and that was only at 8%. Now we're up to 10%. So this index is telling me things have cooled off a little. What the builders are telling me is that they see so much demand coming into their communities that they're willing to increase more than 1/3 of their homes every single week. And sometimes the price increase is $1,000, sometimes it's $5,000, but sometimes it's $10,000. It depends on the price point and the community. But the point is, builders obviously on the ground are seeing things, and we don't know how many homes they're contracting that are going to close in June, July, August, or even later in the year. Only they know that. We're not going to see it until it actually closes. So we have to trust that they know what they're doing, and they're seeing things heating up to where they're raising a ton of prices every single week. But otherwise, what we see here is normal for a spring market that's heating up. Prices are slowly grinding up, days on market is holding steady, Everything else looks normal. Okay, now let's move on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin County, and these are ranked using that same market action index. Remember, a 30 or below is above, so by the time we get all the way up to 63, that is a very hot market. So starting with the absolute hottest cities, Grapevine heats up 2 spots to take the #1 spot this week. Louisville cools off 1, Coppell cools off 1, Ferris heats up 2, which I say this every week, but that's absolute insanity, as at the beginning of the year, this was literally a buyer's market. This was a below a 30 back on January 5th. It was a 28.39. It was one of 2 buyer's markets in Dallas, and now it is the number 4 hottest city in all of Dallas and Collin County. Okay, so Ferris heated up 2, Plano cools off 1, Carrollton cools off 1, Richardson, Sachse, Allen, and Garland all remain in the bottom 4 spots of the hottest cities list. Then we like to zoom in on specific zip codes. The absolute hottest is now almost a 71, and that is Dallas, Texas, 75287, followed by Plano, 75023, Louisville, 75067, Garland, 75042, Irving, 75063, Frisco, 75035, Plano, 75025, Louisville, 75077, Grapevine, 76051, and Coppell, 75019. Now we're doing the exact same thing, but looking at the coolest cities, and the absolute coolest remains Van Alstyne. It's the only buyer's market here in the DFW area, followed by Blue Ridge remains in the number 2 coolest spot. Lavon cooled off 3 spots this week to take number 3. Nevada remained. Leonard heats up 2. Prosper heats up 1. Rockwall cools off 1. Farmersville jumps onto the list out of nowhere. Salina as well jumps onto the list out of nowhere. Whitewright heats up 3 spots to become the hottest city on the coolest cities list, and both Rowlett and Seagoville, which were the 2 hottest last week, have fallen off the list this week, so they heated up off the list. Now looking at the coolest zip codes, the absolute coolest is Van Alstyne, 75495, followed by Dallas, 75205, Dallas, 75204, Blue Ridge, 75424, Lavon, 75166, Nevada, 75173, Mesquite, 75181, Dallas, 75203, Grand Prairie, 75054, and Irving, 75038. As always, if you're looking to buy, sell, or invest in the Dallas area, whether it's next week or next year, call, text, or shoot me an email. All that is in the description below. Thank you for watching, and I'll see you in the next video.